Listen. Right now, the pound is sitting on a trapdoor. Not a guess, not a hunch, the numbers are screaming it. 1 hour ago, pound sterling to US dollar printed a fresh strong sell signal. The MACD on 4 hours is flashing negative, and the daily chart is coiling like a spring loaded with a month of bullish structure behind it. There is one danger zone and one hidden opportunity right now. I'll show you both. Stay to the end. I'm giving you 3 exact levels you can trade today, with your stop set, your targets locked, and the one invalidation number that erases everything. Price at this second is 1.3415. We're up a few pips on the session, a tiny 0.06%, but do not let that green fool you. The intraday trend is a brutal battle. The 1 hour chart is screaming strong sell, yet the monthly trend is firmly buy. That is a trap. When lower timeframes turn aggressively bearish while higher timeframes hold bullish, retail longs get liquidated, then the real move begins. So here is your session verdict. Right now, pound sterling to US dollar is in a fading range. Not a clean trend, not a breakout, a fading, mean reverting mess that wants to hurt chasers on both sides. The single invalidation level that flips my entire bias is 1.3386. Write this number down. If we close any 4-hour candle below 1.3386 today, the entire structure resets from neutral bullish to outright bearish, and we target the 1.3367 zone and then a liquidity run toward 1.33. But if we hold above 1.3386 and then reclaim the pivot at 1.3436 on volume, the dollar killers step in and cable can melt up fast. That's your binary. Now here's what the herd is doing, and it matters. Retail sentiment data shows over 60% are still net long, sitting in chop, bleeding premium. Institutional positioning, from the latest CFTC futures, reveals speculators trimmed net longs for the second week. The big money is fading strength. Option expiries today show a massive 1.3450 strike, right near the pivot, with another at 1.3500. Market makers will defend those levels. So the trap is set, price hugs the pivot, longs feel safe, but a single headline can run stops below 1.3386 and then reverse. This is classic accumulation before a breakout, or distribution before a dump. And the next signal changes everything. But before you take a trade, let's walk the chart exactly like I see it on my screens, top down, from weekly to 60 minutes. Pull up your charts. On the weekly, we have a neutral candle structure with the moving averages flattening. The weekly MA50 near 1.3451 is acting like a ceiling. The price has been unable to close above it for 3 weeks. Yet the monthly buy trend remains intact, with the 200-week moving average climbing from the low 1.28s, nowhere near price. That long-term structure says the trend is your friend, until it's not. Drop to the daily. This is where the trap tightens. The daily MA200 sits at 1.3386. That's the brick wall, the line in the sand. Price bounced off it 2 days ago and is now consolidating right at the MA100, which is 1.3438, basically the pivot. So you have a compression between the 200-day and the 100-day, a classic coil. ADX on the daily is 21.9, below 25, confirming no trend. That screams one thing: a volatility expansion is coming, and it will be violent. Now move to 4 hours. Here's what most traders miss. Look at the 4-hour MACD. It's printing negative with a reading of -0.002, and more importantly, you see a hidden negative divergence. Price made a higher high near 1.3480 a few days ago, but the MACD line failed to confirm. Buyers are exhausted. That's the trap for late longs. On 4 hours, we also see MA20 at 1.3429 curling down, and price is below it. The 4-hour trend is neutral, but the momentum is leaking south. Supports on this time frame are carved out. S1 at 1.3417, which is already being tested, S2 at 1.3386, the daily 200, and S3 at 1.3367, the previous swing low from last week. Resistances stack at 1.3467, then 1.3486, and the big 1.3517, which is the weekly A3 and the zone that if broken flips everything to a breakout melt-up. But right now, resistance is heavy. Finally, the 60-minute chart. This is the execution lens. It's the strongest sell signal of all time frames. The 1-hour RSI is 48, neutral but sloping down. The fast stochastics at 56 are rolling over. Price is below the MA20 and MA50 on this chart. Each bounce is being sold. The 1H strong sell pattern suggests we see a sweep of the 1.3410 area and a likely test of 1.3386. Within the session, unless the fundamental driver overrides the technical. This is where cross-asset linkage gets fascinating. And that's exactly where the money is made. Keep watching. Let's connect the fundamental dots, because this is the dollar killer narrative you must understand. Overnight, sterling climbed on US-Iran deal optimism. That's a risk on pulse, and cable typically benefits when the dollar weakens on easing geopolitical tension. But the move was muted, only 8 pips of net gain. Why? Because the pound market is waiting for a growth shock. The analyst community is screaming the same thing. UK GDP data tomorrow could be the trigger, and the Bowes policy path is under a microscope. Meanwhile, the yield spread between UK gilts and US Treasuries has been compressing. The 2-year spread narrowed 3 basis points this week, reflecting doubts about aggressive Bow rate cuts being priced out while the Fed holds steady. That spread compression is a dollar killer in the making, but it needs a catalyst. If tomorrow's UK growth print misses, the pound gets hammered as recession fears spike. If it beats, we could see a sharp repricing of Bow expectations and cable rips through 1.3500. So the 1-week directional lean is cautiously bullish above 1.3386, targeting 1.3500, but with a hard invalidation on a daily close below that 200-day MA. The event that invalidates the bullish lean is tomorrow's UK GDP at 7 o'clock London time. If it prints below 0.1% month-on-month, the structure cracks. Here's your interaction trigger. Do you think cable reclaims 1.3500 this week? Comment yes or no right now. I'm tracking consensus against institutional flow. Hit that comment section now, the section most people skip. That's exactly where the money is made. I'm going to lay out 3 trade setups with exact entries, exact stops, exact targets, and the on-screen plan you can screenshot. This is not a signal service. It's a plan for your own analysis. Every setup respects the volatility we have, with ATR at 72 pips, so stops are wide enough to breathe but tight enough to protect capital. Strategy 1 is the sniper, conservative, built for the patient trader who wants one high probability shot. The sniper waits for the trap to spring. The condition: we need a 4-hour candle close above the pivot and the MA100. Both sit at 1.3436. But not just any close. We want a close above 1.3450 to clear the option strike and confirm buying pressure. Entry is on the pullback to 1.3440 after that breakout, with a stop-loss placed below the 4-hour demand zone at 1.3380, just beneath the daily 200 MA, giving a 60-pip cushion. Target 1 is 1.3500, a logical resistance and option barrier, giving a 60-pip reward, risk-reward of 1-to-1. Target 2 extends to 1.3530, the weekly R3 zone, for a total reward of 90 pips, roughly 1 to 1.5 R. What voids this setup? If price fails to close above 1.3436 and instead closes a 4-hour candle below 1.3386, the invalidation number. This sniper plan is dead and we flip short. Here's your on-screen graphic for this setup. The sniper, conservative, entry, 1.3440, pullback after 4 hours close above 1.3450, stop loss, 1.3380 take profit 1, 1.3500 take profit 2, 1.3530 risk, reward, 1:1.0 R, TP1, 1:1.5 R, TP2, invalidation. Void if 4H candle closes below 1.3386. Strategy 2, the active trader. This is for the mean reversion specialist who trades the range. We see the 1 hour strong sell. We see price hugging the 1.3415 area. The active entry is a bounce play. Wait for a sweep below the S1 support at 1.3417 and a push toward the 1.3386 to 1.3390 zone, the daily 200 MA. That area is a high probability demand zone where buyers will defend. We enter long at 1.3392 with a confirming 1 hour bullish engulfing candle closing above 1.3400. Stop loss goes at 1.3360. 10 pips below the S3 support and the last swing low, risking 32 pips. Target 1 is the pivot at 1.3436, an immediate 44 pip gain, giving a risk reward of roughly 1 to 1.4. Once target 1 is hit, move your stop to break even and set a trailing stop of 25 pips for target 2 toward 1.3467, the R1 resistance. This plan capitalizes on the bounce that market makers engineer after stopping out weak longs. The setup is void if price fails to hold 1.3386 and closes below it on the 1 hour. If that happens, cut early. Type your pound sterling to US dollar range for tomorrow in the comments now. Let's see who's aligned with this mean reversion play. Here's the graphic. The active trader, standard. Entry, 1.3392. 1H bullish engulfing close above 1.3400 after sweep of 1.3386 to 90, stop loss. 1.3360 take profit 1. 1.3436 take profit 2. 1.3467, trail stop to break even after TP1, risk, reward. 1:1.4R, TP1, open for TP2 invalidation. Void if 1H candle closes below 1.3386 without reclaim strategy 3, the aggressor. High risk, counter trend, for those who can lose small and manage risk aggressively. The 1 hour strong sell is not to be ignored. If price rejects the pivot at 1.3436 and fails to break higher, the aggressor shorts the breakdown of the 15-minute support at 1.3410, with a tight stop at 1.3437, just above the pivot, risking 27 pips. Entry is at 1.3408 on a 15-minute close below that level. Target 1 is 1.3386, the daily 200 MA, a 22 pip scalp with almost 1-to-1 risk. Target 2 is an aggressive extension to 1.3367 if momentum accelerates. You must be flat by London close. No overnight holding. If we get a sudden headline that spikes price above 1.3450, you're out instantly. This is a trapdoor play, pure and simple. Only take it if you are prepared for a whipsaw. Here is the graphic to the aggressor, high risk, entry, 1.3408, 15M close below 1.3410 after pivot rejection, stop loss, 1.3437 take profit 1. 1.3386 take profit 2, 1.3367 risk, reward, 1:0.8R, TP1, 1:1.5R, TP2, invalidation. Void if price trades above 1.3450 intraday risk management pulse. Never risk more than 1 to 2% of your account per trade. No open positions through tomorrow's UK GDP release, the event. Risk is binary. Stops are non-negotiable. If you lose 3 trades in a row, step away. This is how you survive to trade the next big move. Now listen closely. The single most critical level for the next session is still 1.3386, the daily 200 MA. If that level breaks and holds, the monthly by structure gets challenged, and we enter a bearish phase targeting 1.33. If it holds and we get the GDP catalyst, a violent squeeze above 1.3500 is on the table. Tomorrow's focus is entirely on UK GDP and the subsequent repricing of BO expectations. I will cover it live in the next 8 asset breakdown. Make sure you hit the bell so you don't miss the exact entry levels before the number drops. If you want the full breakdown on Bitcoin and the S&P divergence, that video is live now. Tap the end screen. Smash like if this gave you a clear plan. Subscribe, hit the bell, and I'll see you in the next one, right when the trap snaps.